After 40 years of war, for decades of suppression, manipulation, and price smashing, the opposition has finally surrendered. After the Hunt brothers were crushed in 1980, after the $50 silver collapse in 2011, and after the spoofing scandals exposed in 2020, the enemy has laid down its weapons. Ladies and gentlemen, Asian Guy here, and for the past 10 years, every silver investor on Earth has been telling the same story. We whispered it in forums, shouted it on YouTube, and printed it in newsletters. The message was simple. Silver will never be free until the banks stop shorting it. We didn't just believe it, we knew it. A cartel of massive U.S. bullion banks, led by names like J.P. Morgan and Citi, stood like a stone wall against any sustained rise in silver prices. Every time silver tried to take off, they flooded the market with paper contracts. They didn't need to smash the price outright. They were the suppressors. But this morning, the war ended. Not with a bang, but with a PDF. The U.S. government released a document, the CFTC's Bank Participation Report, and what it shows is nothing short of astonishing. A statistical impossibility. A reversal so complete it permanently alters the math of the silver market. For the first time in modern history, the big four U.S. banks are no longer net short silver. They are net long. Let that sink in. The suppressors are no longer trying to stop the price from rising. They've switched sides. They've front-run the entire market and positioned themselves to make billions, not from silver collapsing, but from silver exploding. And here's the dark twist. The part that makes this one of the most dangerous financial moments of our lifetime. If the U.S. banks sold their short positions, who bought them? Because for every seller, there must be a buyer. If J.P. Morgan stepped off the tracks, who did they tie down in front of the train? The report gives us the answer, and it's terrifying. J.P. Morgan and the other U.S. giants handed the bag. Over 215 million ounces worth of short positions to foreign banks, Europeans, Canadians, and Asians. They trapped their competitors in the mother of all short squeezes, then flipped the switch and went long. In this documentary, we're going to tear this report apart line by line. We'll examine the trap that was set back in October and analyze the historical data to show why this may be the endgame signal for $100 silver. The banks have stopped fighting. Now, they're riding the rocket with us. And in a world of fake news and AI rumors, there's only one thing that matters: official government data. Every month, the Commodity Futures Trading Commission releases the Bank Participation Report. It shows exactly what the largest banks on Earth are doing in the futures market. For years, opening this report felt like walking into a crime scene. U.S. banks consistently held massive net short positions, 20,000, 30,000, sometimes 40,000 contracts. That short position was a ceiling, the invisible hand that slapped silver down every time it approached $30 or $40. Now, look at December 2025. U.S. banks reported long positions totaling 18,611 contracts and short positions of 17,838 contracts. Do the math. That's a net long position of 773 contracts. It doesn't sound like much, but in high finance, it's seismic. It's like discovering the iceberg has started moving away from the Titanic. For decades, that number was deeply negative, representing billions of dollars bet against silver. Today, it's positive, and incentive is everything. When banks are net short, they benefit from falling prices. When they're net long, they benefit from rising ones. The incentive flips, and with it, the paper ceiling that held silver down begins to evaporate. To understand why this shift is historic, we have to look back. In 1980, when the Hunt brothers drove silver sky high, the exchanges changed the rules and forced a crash. In 2011, as silver surged again, a series of sudden margin hikes crushed the rally. For 40 years, the banks acted as guardians of the status quo. So why stop now? Not morality, reality. Unstoppable physical demand from solar panels, electronics, and advanced batteries may have made continued suppression a losing bet. A smart predator doesn't fight the current forever. Eventually, it stops holding the beach ball underwater and decides to ride it up, but the story gets darker. If J.P. Morgan is no longer the villain, who is? Who takes the loss? Futures markets are zero-sum. If U.S. banks are long, someone else must be short. And that's the trap. In high finance, there are no friends, only counterparties. When a bank exits a massive, dangerous trade, it doesn't just walk away. Someone has to take the other side. Someone has to hold the bag. So when U.S. banks spent the last 3 months aggressively covering shorts and flipping long, who stepped into the path of the steamroller just as the driver jumped clear? The report answers that too. Non-U.S. banks increased their short positions. quietly, steadily, walking straight into history's largest silver squeeze. While U.S. banks were sprinting for the exits, foreign banks were doing the opposite. The giants of Europe, the heavyweights of Canada, and the state-backed banks of Asia were doubling down. They didn't just maintain their short positions. They expanded them. They absorbed virtually the entire short exposure that U.S. banks unloaded. The result is staggering. Foreign banks are now carrying a net short position exceeding 215 million ounces of silver. Put that into perspective. 215 million ounces represents roughly 25% of global annual mine production. These banks are effectively shorting 1/4 of the world's yearly silver supply, at a time when silver is trading an all-time high of $67. The physical market is already in deficit, and their former allies, the U.S. banks, have abandoned them. This isn't a hedge. This is a suicide pact. So why would U.S. banks do this? Why leave their European counterparts exposed? Because this isn't just a market trade. It's a geopolitical chess match. The U.S. dollar is under pressure. BRICS nations are building alternative payment systems. Gold is hitting record highs. Western balance sheets are buckling under historic debt loads. In this environment, there are no alliances, only survival. The U.S. banks saw the writing on the wall. They knew the silver suppression game was reaching its end. Fighting physical reality any longer would eventually destroy them. So they made a cold, calculated decision. Save themselves and sacrifice the foreign banks. By flipping net long, U.S. banks have weaponized the silver price against their rivals. Think about what happens next. If silver hits $70, U.S. banks profit. But at $70, foreign banks sitting on 215 million ounces of shorts face billions in margin calls. The exchanges will demand more collateral, more cash, or forced liquidation. At $75, the pain becomes intolerable. Capital starts bleeding. Foreign banks are forced to sell other assets, stocks, bonds, even gold, just to keep their silver shorts alive. And who's driving the price higher? Physical stackers. Industrial giants like Samsung, solar manufacturers, and now the U.S. banks themselves. J.P. Morgan sits back holding its new long positions, watching prices rise and competitors squirm. They have zero incentive to stop the rally. In fact, they want to accelerate it. Their goal is a margin call cascade, a panic buying event. Because when a bank short 215 million ounces finally breaks, when it taps out, it must buy back that silver in a market where the metal simply doesn't exist. That's when charts go vertical. That's when you see $50 days and $100 days. It's financial execution, and the lever is being pulled by the U.S. banks. And it gets worse. The CFTC report only covers COMEX futures, the visible, lit market. Beneath it lies the real beast, the OTC derivatives market. Swaps, forwards, structured options, private, opaque, and largely unregulated. This is where the real exposure lives. Estimates suggest the OTC silver market is 10 times larger than COMEX. So if U.S. banks have flipped net long in public, what have they done in private? We can't see the data, but we can see the footprints. If they were desperate enough to flip their reported positions, you could be certain they've unwound their OTC shorts as well. They're cleaning the books. Analyst John Lindo raised a critical question this morning. Have the 5 major U.S. bullion banks closed out their massive derivative short positions because they know the endgame has arrived? The answer is almost certainly yes. They are de-risking. They are preparing for a reset. This explains last week's volatility. It explains the strange movements in platinum vault data. It explains soaring lease rates. The banks are frantically dismantling decades of suppression structures because they know the dam is about to break. And here's the most telling signal of all. The spoofing has stopped. Look at the last 3 days of price action, where the waterfall smashes. The 9 a.m. dumps, the massive red candles that appear out of nowhere to kill momentum, they're gone. For the first time in years, silver is trading normally. It rises, consolidates, and rises again. Why? Because the smasher isn't smashing anymore. The smasher is buying. And when the biggest manipulator in the market stops manipulating, you know the trend is real. This isn't a fake out. It's a jailbreak. Now assemble the full picture. We already had the physical crisis. Samsung buying mines, solar consuming 30% of supply, J.P. Morgan owing China 129 million ounces. That alone was enough to justify $100 silver. The supply-demand imbalance was a powder keg. The banker flip is the spark. It removes the final line of defense for low prices. It eliminates the short cap. It turns the U.S. banks from enemies into allies. When markets open, The algorithms will read the CFTC report. Hedge fund models will see U.S. banks net long, and they will buy. They will front-run the squeeze on foreign banks. This creates a feedback loop of destruction. Higher prices trigger algorithmic buying. Algo buying squeezes foreign banks. Foreign banks covering drives prices higher. Higher prices trigger physical hoarding. A self-reinforcing cycle straight up. And the U.S. banks, the architects of the system, are sitting back, watching it burn. So here's the verdict. We are no longer waiting for a catalyst. We are no longer waiting for confirmation. The signal is here. When the very institutions that built the paper-silver suppression scheme flip net long, it tells you everything. They've seen the internal data. They know industrial demand is draining supply. They know the vaults are empty. And they know their foreign competitors are trapped in an unclosable 215 million ounce short. This is why $100 silver is no longer fantasy. It's math. The $50 paper wall is gone. The $60 suppression is gone. The $70 ceiling has been removed by the banks themselves. We're entering a vacuum, a zone of zero resistance. When markets open, algorithms will react. Foreign banks will scramble for liquidity. Industrial buyers will panic. This will be a super spike, fast, violent, and unforgiving. If you're not already positioned, you won't catch it. Expect volatility. Expect chaos. But remember who's on your side now. For the first time in history, you're trading with J.P. Morgan, not against them. They want the price higher. They need the price higher. The banks have flipped. Industry is panicking. The shortage is real. The era of cheap silver ended this morning. Welcome to price discovery. Hold your mettle. Watch the fireworks. Don't blink. I'll see you on the other side of $100.